You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, that rockin' tune means it's time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. Coming at you one last time here for 2014. We are recording this on Monday, December 29th here, 2014. This will be our final show for the year. No show, of course, on Thursday, which is, of course, New Year's Day. We'll be off celebrating, taking some well-deserved time off, planning for the New Year's worth of shows. But we thought, what better thing to do here with our final show of 2014 than take a bit of a look back at the year that was from an overall markets as well as from an options trading perspective, and break down some of the developments and the stories and the trades and the misperceptions and all the other fun things that we noticed in the year that was 2014. And then if we have some time towards the end there, we can also rope in what we're thinking about, what we're watching, what we're keeping an eye on, what you guys should be keeping an eye on for in the coming year here into 2015. And joining me to do just that one last time here in 2014 is my usual colorful cast of characters, starting off with the man of many hats, a.k.a. the Viceroy, a.k.a. Alex Jacobson, the major domo of education and many other things over there at Options Express by Charles Schwab. Mr. Viceroy, welcome back to the show one last time for 2014, sir.
Hey, Mark, good to be here. Not a lot of stuff going on in the market today, but a lot to talk about in terms of the 2014 retrospective. So should be a fun show today.
Yeah, we're looking back. We don't need any trading today. Today could be one contract day. Doesn't matter. We got more than enough to fill the hopper for today. And joining me also to help me fill that hopper, the man beaming in from the scenic hinterlands of Chicago, known far and wide, and beloved indeed far and wide, as St. Charles, Illinois. You know him, you love him, as Uncle Mike Tusaw from RCM Wealth Advisors. Uncle Mike, welcome back to the show. Indeed, one last time here in sunny and scenic 2014.
Oh, it's always fun to be here. And actually, I'm looking out my window. The sun is out here. What a day.
Yeah, I don't know if it's not warm and tropical, but there is at least some sun out there. I'm sure you're probably sad about that because you want to be out there riding the snowmobiles right now.
Yeah, it's been a disappointing snow season, to say the least. But we'll get over it.
It started off so strong. We had snow on Halloween for the first time ever. And then that was pretty much it until here we are almost on New Year's Day now and not much else, which personally I don't mind. But hey, to each their own. And speaking of each their own, we also are joined by our diehard Mainer of the group. You know him, you love him as the Rock Lobster from OptionPit.com, as well as myriad various enterprises floating around over here as our editor-at-large over here at the Options Insider. We keep him busy, folks. Mr. Andrew Giovinazzi. Mr. G, welcome back to the program. Indeed, to you as well, sir. One final time here in 2014.
It's great to be back. All I can say is it's our last big shoe. Our last big shoe for 2014. I don't even know what to do with our last big shoe.
Looking forward to a very big shoe indeed. So I think without further ado, let's dive right into it. Let's dive into a very special trading block to look back on the year that was 2014.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the Trading Block.
All right, everybody. You know what this segment usually means. Usually it's time for us to break down the day's activity, as Alex alluded to. Not a whole hell of a lot. Most of the major indices up fractionally on the day. VIX Cash also up nearly a full point on the day as well, which is interesting. We usually would dive into that quite a bit, but we actually have a lot of other things to talk about here today. I think what we'll do to kick this off, we have a lot of topics on the agenda, but as I am wont to do here, it's a participatory show. I will open it up to you guys to dive in first. I'll let each of you perhaps toss in the first topic that really comes to mind for you when you're looking back on 2014 and give some of your thoughts on that, and then the rest of us will chime in. And maybe, Uncle Mike, perhaps we'll start with you. I have a feeling I think I know where your interest lay throughout most of 2014, but perhaps you'll surprise us. Never know. So what comes top of mind for you when you look back on the year that was 2014?
Well, I'm kind of thinking on this. I would say that maybe the 2-year Treasury compared to the German. Oh, I'm just kidding. Apple.
Oh, I'm sorry. Did I toss it to Alex by mistake? Let me fix that in my switcher board here.
It's with Apple. Apple had another big year this year. A lot of people at the beginning of the year were concerned about it, I remember. And it's been a very fun year to be in Apple, to say the least. A year before in 2020. It had a very exciting road to nowhere, so to speak, is what I like to say. It didn't really move a lot from the start to finish. I mean, it moved, but from start to finish, it really was not that huge by Apple standards by any means. But 2014 was a banner year for Apple, and very excited about 2015.
And the year's developments, did it really cause you to change any of your outlook? I mean, obviously, you're still net bullish on Apple, but the way we saw, of course, the split and the resulting development, have you changed looking back on it over the year that was compared to certainly a year or two ago? Has it changed the way you approach Apple at all from an options perspective? Are you starting to, I know you're still primarily long stock, long put out there, but you're starting to roll a lot more with some of these weekly put spreads to finance things. Have you found yourself changing up the way you approach Apple at all in 2014 and maybe thinking about doing it more so in 2015?
If anything, I'm more bullish. If I could put more money into Apple right now, I would. But with that, not looking to change much. I haven't actually had any put spreads or any type of financing style plays in the last couple of weeks, just because of the fact that a couple of weeks ago, before Janet Yellen told us everything was going to be okay again, it was very choppy and difficult to really get into anything. So I simply abstained. But then with us getting closer to Christmas and Apple recovering a little bit, I didn't really want to try and get too cute and try and sell premium too close to the current price of the underlying, just because of the fact that we've had a pretty decent year with Apple, and also because of the fact that if the trade's not there, I say don't trade. So to answer your question, I'm not really changing much going into next year. If anything, if I could be more bullish, I would, but I really can't be at this point.
Yeah, certainly there's a lot on the horizon, certainly maybe from a volatility perspective going forward here in Apple in early 2015. Of course, next week coming up, we have the big Consumer Electronics Show. Not a big mover traditionally for Apple. They don't play there, but a lot of the other consumer electronics sector will move, and that could, of course, maybe translate into some movement, some volatility for Apple. Then, of course, if they stay on their target, which I believe initially was end of Q1 with March, that may move quite a bit, but we could also see that next big tentpole in the Apple ecosystem, the watch. It's already very hotly debated, hotly contentious, which, of course, whenever you have that for a product, that's probably going to translate into some volatility in the underlying. So certainly should be a few things to watch here in the early part of 2015 from an Apple perspective. Alex, would you concur? And probably, I'd imagine if you had to look back on the year that was from 2015, I almost said 2015, I'm getting ahead of myself, from 2014, you probably would say Apple was still very much a leading story on the brokerage side of the fence as well, would you not?
Yeah, unquestionably, Apple was the big story of the year, but there were a couple other threads. Obviously, oil losing almost half its value in a matter of weeks is going to be a big part of the 2014 story. I've already gotten the abuse over interest rates, but I think the 10-year coming in 100 basis points below where we would have expected it a year from now, maybe even 130 or 140 basis points below where we would have thought. Also, a couple industry things. We saw more consolidation in the brokerage community, and we saw changes in portfolio margin, which I know impacts a small number of people, but the other thing, and the more I thought about this, is the fact that OCC had to raise money this year. Now, I know, again, that's kind of an industry insider issue, but the fact that the clearing corporation, to the best of my knowledge, other than when they've actually had a member suffer a loss and they needed to replenish that capital, the fact that OCC was and is now viewed as critically important and had to bring in another, I think it was $150 million from the exchanges. I don't think anybody saw that coming. And I think that goes sort of hand in hand with the portfolio margin issue, that the world has a different view of risk. And geopolitical risk, as we saw this year, as we saw today, people running out of Greece, people diving out of the ruble again. Geopolitical risk has impacted us quite a bit in the last year with, the events of Crimea and the October volatility. So there were a number of threads going on this year.
Well, Alex, you raised pretty much a whole show's worth of topics right there. I think we'll parse them out a little bit at a time. You did mention, of course, the OCC issue. That is very top of mind. They did, just raise some money. It does indeed reflect the changing nature of that organization as a systemically important entity, and they need more funding to do that. I think we'll get into OCC a little bit later when we talk about options volume as well. But before I dive off the Apple tip, I know a lot of our listeners are very diehard Apple devotees here on the old program. So, Angela, I think we'll round it out with you and your take here on Uncle Mike's topic of Apple. Certainly a top of mind for a lot of your clients, a lot of your mentees. I'm sure a lot of people come to you guys on a daily basis saying, hey, they could probably just talk about Apple all day. So what's your take here on the year that was from an Apple perspective, whether volume-wise, volatility-wise, whatever caught your eye this year from an Apple perspective here in 2014?
From an through the Apple lens, huh?
Through the Tucson Apple Zealot lens.
What I thought, what interesting about Apple was how underpriced volatility was through most of the year for earnings in Apple. Probably one of my better ideas of the year in Apple was just the earnings had gotten. You basically could buy. There was a time when people cared so little about Apple earlier in the year. That you could buy earnings volatility for, back month volatility for basically average levels going into earnings. And of course, Apple had that one blowout report, and it just so happened that was the trade time that I looked at. I think that was it was buying the June cycle, and it was the April earnings when it just totally. It was up like 15 or 20% or something like that. But I think Apple volatility for a while was trading cheap, and it's getting, it's coming up a little bit now, even as we go into the end of the year. So at least from a vol perspective, it got very underpriced, and it got underpriced again on the last earnings because just the thing is the breadth of the moves over like a 2-week period after earnings. You buy that back month juice, and you could sell a little bit of the out of the money earnings stuff to finance it, and Apple would have these 15 or 20% runs, which is what we've been getting. So really, just, all I would say is everybody thinks, or there's a common conventional wisdom about selling earnings premium, some of these. And I think this is one of the years that I think Apple included where you did not do well selling the earnings in these things. You actually did not great. So,
yeah, that was kind of thematic for a lot of the big earnings events over the past few cycles. It was you got run over quite a bit if you sold premium very aggressively.
Yes, run over by a 16-wheeler Mack truck or 18-wheeler Mack truck. I guess it's an 18-wheeler. So, at least from the Apple point of view, is Apple. I mean, I think it's a more fairly valued stock now. It's at a reasonable. It's probably at a market multiple. I guess they got back on the earnings growth train, and I think for me to get super interested in Apple again, not saying that Mike's wrong because he's been right pretty much for the whole time, but I'd like to see another product come out of these guys. They're selling tons of phones and they're selling more Macs, and the ecosystem is huge now. But, it's still, a 10% Apple world and a 90% Android world, which is, is not that is always not the best position to be in, although Google's coming under some antitrust fire from the EU. So anyway, as far as Apple goes, I think that the potential for that still to move is still very big.
Well, Alice, like I said, you raised a number of very interesting points. I think we'll dive into one of them that you raised, which is very much top of mind for a lot of our listeners right now listening to the show. That is indeed crude. Crude kind of being the surprise development here in the last few months here in the marketplace. If you look at the year that was 2014, we were very much bookended by two very interesting events. We had the beginning of the year with the whole Ukrainian crisis that really spiked a lot of options volume, a lot of volatility in the marketplace. Then that receded somewhat into the summertime, and then getting into October, almost like cliche, that took off again with the extreme volatility and indeed vol that we saw exhibited in the marketplace in October, and then wrapping out of October into the latter portion of the year, we saw crude oil just taking on the chin. In fact, as we're recording it today, listeners, on Monday, December 29th, we saw crude hit a 5-year low today. This is the NYMEX light sweet crude I'm looking at here for February delivery, settling out today, $53.61 a barrel. That's on some news of a oil fire, I believe, over there in Libya, and that of course affecting some. Actually, there was a rally earlier that was driven by that oil fire news that turned out to be not well-founded, so this oil has taken on the chin. Again, that's the lowest settlement for that contract since May 1st of 2009, and overall, this is pretty much marks the 50% decline period from the height of this contract set not in recent years, just in this year, on June 20th. It's only taking 132 trading days for this oil to essentially be cut by 50%. That is the fastest drop in the front month contract since 2008 here. So it's only happened faster, actually twice in some interesting data points. So we're looking at here from in 85 and 86 and a 1990-91 period. So kind of in some rare company right now from an oil perspective. Alex, tell us what your take is on the whole oil issue and what's going on as a result over there at OX, what kind of volume you're seeing, and in essence, what was your take on this oil drama unfolding at the end here of 2014?
Almost from October forward, the both desks, what I'll call the securities desks and the futures desks have been dominated by oil ideas, and especially on the futures side, people actually trading the crude contract, trading the crude options. USO, a product we like to beat on, still big volume up here, and at Schwab as well. That's kind of the fast food side of it. But this was one of those, monster events that you kind of look back at. This is like Soros and the British pound, where he turned option spreads into, $4 billion payday. This was one of those huge events where someone's going to have a book out in early January or February, and I'm speculating on that, about the number of people who saw this and, made lots and lots of money. I mean, the air just came out of that market. It was just remarkable. And as we've talked about on the show repeatedly, even the skew sometimes made these things look expensive, but yet they weren't because the moves were so big. And to your point, even today where we had a little rally, potential bad news about Libya that wasn't accurate, we still set another new low today. And I think if you'd ask people in September, October, where you'd see crude, I bet the price guesses would have been clustered in the $90 area. And if there were outliers, it would have been the $120, $130 area. So this was kind of a shock to the system. I'm actually a little bit surprised that the market did as well as it did. It kind of demonstrates the resiliency in stocks right here, but kind of surprised that the market has done as well as it's done, with oil losing essentially half its value in a little over 4 months.
Yeah, oil, certainly the drama we've seen unfold over the past few months gets my vote for just the surprise story of 2014. In fact, we watched this and we kind of almost regularly even mocked it, even on some of our programs on this network, like Futures Options Roundtable, where we looked at things like the evolving volatility skew out there in Brent and WTI and said, wow, people are getting crazy. Back when it started dropping from the 90s into the high to mid 80s, everyone said, well, this is getting a little bit overdone. People are paying exorbitant amounts for these downside puts. Clearly, this is not the right trade. You're right. If anything, it's probably going to maybe hover these levels, drop a little bit lower, or certainly maybe rebound. It certainly seemed like for a while there, once it started really aggressively falling, that the stopgap point would be at 70, that's certainly where the Saudis and others would step in, and we did not see that, and those put premiums continued to mount, and the underlying continued to slide, and now we're finally seeing, now that we've cut it essentially in half, we're starting to see that shoe start to drop, the other shoe start to drop, I should say, and the worm start to turn, to throw all the cliches in there, and people actually start to get interested in some upside in oil again. We're seeing people loading up on verticals and upside and just net long bullish speculations in the futures and others. So it's been an interesting road to watch develop. I certainly, a lot of people never thought it would get this far, certainly not 50%. It seemed when people were paying through the nose for those 65 handle and 60 handle puts that they were just the most dramatic of bearish pessimists in the oil market. And it turns out those concerns were indeed well-founded. Mr. Tusaw, we'll toss to you next. I know you like to watch the shiny, glittery commodities, but there's been some action out there in the black tar stuff as well, the Texas tea, if you will. Has this caused you to perhaps start opening your eyes to maybe diving into some of the big crude contracts and maybe doing some interesting plays out there? And what's your take on, in general, what we've been seeing evolving out there in the crude space over the past few months?
A couple things. I was talking with a client actually about a week ago, and I do think that now is a time, I'm not saying going all in, but I am starting to add some exposure to XLE. Just because of for a couple of reasons. Number one, it's low. Buy low, sell high is kind of the general concept behind it. But let's say that I'm wrong. This is a client with a decent amount of money, but we put a small amount of cash into XLE as it's like a starting point. And I said, okay, well, what's our risk management with this? So we decided not to collar it. We decided to just kind of let it sit in XLE without any type of stop loss on it, because we're managing risk and by making it such a small position. So here's the concept behind it that you may want to take, that some of our listeners may want to take in taking on a position in XLE, some type of oil exposure. Let's say that oil continues to go down over the course of the next year or so. And let's say it continues to stay the same or go down over the course of the next 4 or 5 years. Well, if that's the case, for my client, his concept was, well, and this is something that he added to it. He said, well, I'm going to be saving enough money at the pump in terms of because of how much I drive, that even if oil stays at the low levels it is, I'll still be happy because of the fact that I'm not spending that much money on gas.
I'm glad, I don't mean to cut you off. I'm glad you brought that up. I think that is a very much underplayed factor in the marketplace. The entire world is net short oil. We should be getting some long positions around here anyway, because I agree with your client. We are net short as a community, as a whole. So we net benefit from that anyway. So you already have this exposure on. You maybe should be hedging and perhaps even flipping the other way when things get this low. Anyway, I don't mean to derail you, sir. I just wanted to support that last point.
My client will be proud to hear you say that. But anyway, but yeah, that's something that I honestly never really thought of too much until the client brought it up. I like XLE for a variety of reasons. I think that it's just gotten beaten down so badly that if it does go lower, well, if oil were to go to $30 a barrel in 2 months from now, I would be at a stage to where I wouldn't be selling. I'd be buying more of it, quite frankly, because every time it's gone down, it has come back up. And so because of that, I think that oil in general is a good thing to be in at these levels. The other thing with which to consider on this is that we've had a pretty strong dollar, and I think at some point, I have a hard time believing that the dollar is going to continue to rally as much as it has. I could be wrong. You never know. But if we do have a reversal in the dollar, I think that's something that also could play a factor in oil. So I've never really stated it in those words of the fact that we as a community are net short oil, but I like the way that sounds right now. And I think combining with that, along with the fact that oil has gotten so beaten down, plus XLE has to do with energy stocks. If we have a bullish stock market, that can support XLE as well. I think there's a lot of reasons with which to be long or to start getting exposure to XLE going into 2015.
Tusaw, you and I are starting to be on the same page. Scary. I'm not sure what that means. Maybe the apocalypse is nigh. I don't know, but we're starting to lean in the same direction. And even if you don't drive a massive SUV that guzzles, 50 gallons a mile, just net in the, like I said, net in the ecosystem, our consumer goods, the way things are shipped to us. All of us are net short oil at the end of the day. An increase in oil costs us all, so a decrease has the other side of the coin. So we should be thinking about hedging that exposure every now and then, and perhaps even flipping the script a little bit and getting a little bit long when we think it's a decent opportunity. Again, you could be catching a falling knife. Kings could continue to drop, but like you said, there are other extenuating circumstances out there that could mitigate that impact for a lot of people out there. Mr. Andrew, take us home. I know you watch oil usually from the USO perspective. Every now and then you might dive into a few CL contracts. What's your take on this growing tumult here in the oil landscape at the end of 2014?
I don't think, I'll say simply, mostly because it's the same movie I've had before on this. Since the reason that oil has dropped is not been, but there hasn't been like that event, right? Pretty much all of a sudden there's too much oil and local producers or local buyers are just buying it from the U.S. and the Saudi, all of a sudden they can't sell it here. So they're going there, and it's like the old-fashioned, there's too much oil. What do I do with it? So a lot of what's driven the price down kind of was a slow and steady until, the market sort of clears for all this oil. And I don't know, it was peak last year. Everybody's worried about peak oil, and, we've had a 6-year green energy campaign kind of. Maybe I guess they can declare victory now that oil's so cheap. I'm not quite sure what to make of all that. But one thing that's been looking interesting is, because of the skew, you could buy put spreads in USO product for really cheap, which could actually do a fair amount of hedging for puts you might want to sell to execute, a strategy like Tusaw has. You want to buy the XLE, sell some out of the money puts, and buy put spreads in USO, and you'll eventually take delivery on the XLE if it keeps dropping, but you will make money on your put spreads. So you kind of finance or make money on that entry point. So because the pricing has been good, that trade actually has worked. We've looked at variations of it in option pit. I think it's still going to work until oil stops going down. Just keep selling more out of the money puts in the energy stocks and buy more put spreads in USO. And, you just sort of balance it out, and you could have a trade that could actually get, make you some decent money if oil just crawls down. Or even goes down quite a bit more, and you're going to make money on your put spreads and take delivery at much lower levels, the products like the XLE and stuff like that. So I think there's opportunity, but I'm picking a bottom in a commodities kind of, I know it will stop at some point. It feels like it's getting a little overcooked, but The U.S. equity market, the SPX, was trading 660 in February of 2009, and nobody wanted it. So, it's like Mike was saying, buying industries that aren't going away when the market hates them historically has been a pretty good idea. And I don't see the world not needing oil for the next 100 years. So at some point these will, but right now it's definitely funds and people and entities that were in these products are just bailing, because also we haven't really seen how the energy producers are going to be affected by this price. So, the earnings will start coming out in January, and we'll start getting a sense of where this is going to go. So, I think at that point, though, you'll get a good tell on what the future is and how much lower it can go once we start seeing some earnings come from the major producers after sucking on cheaper oil prices for a while.
Well said, sir. I love it. Half an hour, halfway into the show, we've done 2 topics. But, there's a lot of grist for the mill in those 2 topics, so there's certainly a lot to talk about. But, Mr. Andrew, I will now open the floor to you, sir. We've discussed Apple. We've discussed oil. When you look back at the year that was 2014 from an options trading perspective, what really is top of mind for you? What is really the big takeaway you saw in the markets here in 2014?
My biggest one is the speed that which volatility rises. I was just, I'm not a major type of chart guy, but I did see something that was very interesting to me. So you remember when we had you had that Greek referendum, in 2012, I believe it was January 2012, when the market was still a little shaky after 2011 when stocks went nowhere. And don't forget, we had those years of kind of flat stock market performance when the Europeans were having all those troubles with the euro, even though U.S. companies were still, kind of socking away earnings. And the volatility we had just recently, VIX-wise, and the volatility we were seeing now is, or that October, that spike, that is still to me kind of like the Ebola spike? I'm not quite sure. The falling oil price spike was higher than the volatility on what was we thought was a systemically important event. And it just amazed me now how fast volatility can go up and how fast it can go down. It's almost like the spiky charts for the VIX are getting sharper and steeper. And I don't know what that's a function of. It's just, the market is smarter, or liquidity providers just pull the liquidity plug that much sooner. They're like, I'm not selling anything. And volatility it takes a while now to find a new level. I don't know what that's a function of. All I know is that, it feels like it's occurring. We had, 1, 2, 3, 4, 5, 6 decent spikes in volatility. And remember at the beginning of the year, the emerging market crisis, VIX hit 22. And everybody's like, it hit 22. The VIX hit way over 30 just recently in October. You could have bought the whole U.S. equity market, I think, for what do we trade, like 1850 or something like that? It was pretty darn low, right? The swings, like the realized vol swings, Don would, we did trade 1800. Like 1820 something, which would have got you in a nice, in a good spot for the year, actually. And Don would be happy. But I think the realized volatility is making just tremendous moves. And I don't know why it's so more. I think maybe it's partly electronic trading, but I think it's also just a lack of liquidity around. And I think that would be interesting to see what Alex has to think about that. But I think that is going to be with us for a while.
Yeah, we mentioned earlier on the show, of course, the growing importance of just watching VVIX, one of the few products out there that will actually show you that on a demonstrable, chartable, trackable basis, which is, of course, the volatility of the VIX. And it has been, you're right, Andrew, it has been quite a wild ride. I'm looking at that chart here while you were talking. You're right, we've had several spikes just in the past few months, well over the 140 level. It's hovering right around 95 right now. So we've essentially vacillated from about 80 to 140, back down to 80, back up to about 140, and back down to about 95, twice essentially in the past few months. So that's just off the charts quite literally compared to what everything else you're looking at here from a vol perspective. And it's certainly, if all things going forward are pretty much kept the same, this may indeed be par for the course going into early 2015 as well. Certainly something you need to be cognizant of if you're out there trading the volatility products like VIX or any of the related ETPs, as well as, of course, the products that have implied volatility exposure, which is all of them, but in particular, a lot of you guys out there like to trade SPY and SPX, and of course, all of those that correlate very nicely to the VIX. If you're watching it and saying, wow, these implied volatility levels are changing very dramatically, then that is certainly something you will probably need to learn about, because it's going to be probably rearing its ugly head again in early 2015. Mr. Viceroy, anything to add on the topic of the vol of vol that we exhibited here in 2014?
You know, we were having a conversation today up here, ironically, and it was one of those, where are we going with margins and risk-based margin, and couple points came up today. Number one, this is the year that high-frequency trading sort of got looked at really hard. And this is also the year where you realize that there's only two pits still operating on the CBOE. One is VIX and one is SPX. And everything we've talked about in terms of risk and margins and volatility, I don't want to say it's problematic that the two key products still are physically traded, but it's problematic that the two key products are still physically traded, which means at times of market stress, and we saw multiple times of market stress this year, products that are monopoly products, the trading crowds can fade. I mean, they can just step aside, they can just step away. And one of the concerns we have as a brokerage house, and one of the concerns, you know, back to this topic of OCC needing to raise cash, are these short-term events, mini crashes, the October event, the January emerging markets, how Dodd-Frank has impacted upstairs trading and how they're less market-making firms today. And that's a concern. And I think that's why you see the VIX of VIX, you know, spike to 140, 150 levels. I would still like to see more competition in both of those products, both the SPX and the VIX. We're not going to see them in any near future. We were hoping Whaley would release his spot VIX this year, and I'm now beginning to believe it can't be done. I'm now beginning to believe, and I hope I get proven wrong, that actually having a cash product, which would make things a lot easier, would smooth some of the volatility, just doesn't look like it's going to happen.
Yeah, I agree. The Whaley thing certainly is intriguing. We've discussed that on many of our programs, including the Volatility of Use program, and yet you're right, there are a lot of devils lurking in those details that don't seem to be, at least they don't seem to be able to iron them out anytime soon. And certainly, if anyone should have a handle on that, it would be Whaley, and yet they're still struggling with it, which shows the inherent difficulties of creating the type of product they're talking about that has inherent protections against things like roll yield and all the other things people complain about when you're trading a lot of these popular VIX ETPs. Going back to another point you were just hitting on earlier there, Alex, with OCC and just the volume. I think a lot of people coming into 2014 expected this to be a fairly light year from a options volume perspective, and it turns out that wasn't the case. It actually was a fairly robust year. I don't have the exact numbers for December in here yet, but unless it completely fell off a cliff from December. Again, we have a couple extra trading days left. We should have done at least a few 100 million contracts in this month, and I'm sure we did. Then this is essentially on track to be the second busiest year since 2011. 2011, we did about 4.2 billion overall contracts cleared over there at OCC, and 4.6 billion when you count up everything they do, like some of the non-equity futures and some of the debt products, and like just on the equity option side. And about looks like we're on track for somewhere between 3.7 and a half, maybe 3.8, maybe a little bit more here on the equity side going forward. So a very, very robust year. And certainly not a lot of people expected going into the beginning of the year. Then we had that big surge into early Q1 and early Q2 of the whole Ukrainian crisis, really driving a lot of volume in the options market. Then it kind of tapered off, like I said, year very much bookended by two dramatic periods, and then that October period kicked in, and we saw a resurgence of volatility, a resurgence of vol, as we just described, those two big spikes in VVIX coming since October. So certainly a lot of vol out there, and that, is, of course, has translated into kind of kicking up the volume from an overall perspective here into the latter portion of the year. So again, a lot of people probably surprised that we're going to see such a strong year here in 2014. But yeah, once you pull out 2011, which was an aberrant year for a number of reasons from the volume records, this is pretty much the strongest year on record. I think will surprise a lot of people. Let's move on. You touched on another couple other things that are kind of interesting. Maybe we'll touch on them really quickly as well, Alex, because there still are a lot of topics to get to. But you mentioned one that's not the sexiest thing in the world, but it is important to a lot of our listeners out there, and that is margin. We saw a lot of evolution in that space over the past year. We saw a lot of changes in that space. You mentioned a couple of times the OCC having to get funding because they are now indeed a systemically important entity, and they have to have the funding to maintain those levels of risk parameters, risk being a big focus of the year on 2014. You mentioned some firms starting to charge exposure fees, taking another look at how customers trade and if they're adding too much risk to the system, just blasting out downside puts, et cetera, with no hedging, then actually charging those customers more. So risk/margin was a big topic in 2014. What's your take on what we saw on that side of the fence here over the past year?
Well, I think in our space here, in the kind of e-commerce brokerage space, a couple years back, the whole push became all the business you can, cut fees, bring portfolio margining in, and just make kind of this perfect environment. And now you're seeing some people. You saw consolidation in the brokerage community, and that even continued this year. I think one of my forecasts a couple of years ago on one of the shows was we'd see 4 or 5 consolidations, and I got it right, but it took me 3 years to get it right. So in a sense, I didn't get it right. But you had kind of the perfect storm for the individual investor. And now what you're seeing is some people are taking a second look at it and saying, look, we've got to reevaluate some of the risks here. We've got to reevaluate some of the rates we're charging. And, that's kind of a healthy thing for the industry. But I think that's the tone you're going to see in 2015, too. I think you're going to see the industry take a step back and reevaluate risk. This industry is notorious about getting short-sighted. I sat there in a conference room at the SIBO in October of '87 and had people come by and say, this is done. And, you of course said, sit down, calm down, relax. We'll get past this. We'll figure out essentially the changes we need to make. But we have memory lapses. And, we had a mini crash. We had the events of October this year. Ironically, I was on leave during October. And, the big joke was, what did I miss? And, of course, by the time I got back, markets had come back to right where they were. There are a couple messages here. Dodd-Frank killed a lot of the liquidity. And I know I will get emails for that. But Dodd-Frank killed a lot of the liquidity. I mean, market making today is smaller firms. It's fragmented. It's firms that have left. And you say, well, why? And you say, well, the risk reward wasn't there. It simply wasn't there. So we're going to evolve this again. And we're going to evolve looking at risk, and we're going to evolve how we look at weeklies now, the fact that we've got 52 expirations every year. And this business, once again, in the 40-plus years I've been in it, is going to reinvent itself this year. To your point, Mark, I don't think anybody thought 2014 was going to be a banner year. 2014 was a banner year. 2015 is going to be a bigger year. That's what the options industry has always done.
I like it, Alex. Diving into some contentious waters there with the impact of Dodd-Frank on liquidity. A lot of people have very heated viewpoints on both sides of that subject, but I think you're right. I think just what we were just talking about, those massive peaks and troughs in VVIX are testament that something is afoot out there in the marketplace, and perhaps something is systemically different now than it was earlier in the year or certainly last year. And that could perhaps be the fact that a lot of those large players aren't out there providing liquidity in the same way that they used to just a year or two ago. Moving on to some other interesting topics. Uncle Mike, we all know you view the market through essentially two lenses. One is ruby red for Apple, and one is glittering yellow for gold. That was the other commodity that had some interesting fits and starts this year. Not perhaps as sexy of a story overall as crude turned out to be, but still an interesting one. Give us your take on the year that was in 2014 for the shiny stuff.
A lot of things went against it for this year. A lot of outside factors. There was a strong dollar, sinking commodity prices, and I think that with those two things that had happened, the fact that gold is only down, I'm just looking at it from, it's only down a few percentage points since the beginning of the year. I think it just shows the resiliency as to what it is. Gold got pounded in 2013. There's no question about that, but it really kind of held the line this past year. And so my take on gold for the year is that a lot of what happened this year with the strengthening dollar, with bonds going up as they have, with commodities going down as they have, I almost think that in hindsight, which of course we all have hindsight being 2020, in hindsight, I really believe that 2013, you could look back on that to be kind of an indicator of things to come in the other areas with which I just mentioned, and gold just was kind of there first, so to speak. Going forward with gold, I still like it. I like it as a longer-term investment. It's one where over the course of this year, it was very it did have some peaks and troughs earlier in the year, but overall, it really didn't move much from start to finish. It's kind of like if you would have left on New Year's and come back the way Alex did in October. Oh, what did I miss? You really didn't. You missed a lot, but overall, it's about right where it was at the beginning of the year, just down a few percentage points. So with that, I still like the shiny stuff. I still think that it's important to maintain hedges on it in case we do have another year like 2013. But the reality of it is that I think for the long term, fundamentals are on the side of we gold bugs.
Spoken like a degenerate gold bug that you certainly are, sir. Mr. Andrew, anything to add on the topic of gold before we roll on into our 2015 outlook?
Well, I like Mike's point about the, gold being sort of the inflation, the world's going to end bet. That was pretty powerful in 2012. And in 2013, everybody looked at each other and went, well, I guess it's not going to end. And they crushed it. I guess that's the only reason, right? Because all the funds that were long it forever started getting out, and that drove the price down. And right now, gold really has been actually pretty sedate. I mean, it's kind of hung here, but in what was the range of gold this year? Like 112 to 125 in the GLD, something like that. I mean, pretty, it's just, I think the fact that it's not doing a whole lot is reflective of, like a 129 high, and I guess it's trading, 109 is the low. Pretty moderate range for that, for the shiny stuff. And as we look at it, you think, well, if gold's not doing a whole lot, then maybe what does that say about the dollar and inflation and everything else? You're going to see more stability there. And generally, more stability ends up being good for stock prices. It doesn't mean you're going to get that great buying up. Maybe you'll get a couple of buying opportunities like you got in 2013 when everybody just freaked out that something bad was going to happen. And that's when you have to be ready. But the fact that gold is ending the year, it looks like it'll be down on the year, but not by a ton, is just indicative of the, it's about flat for the year, is just, I think, indicative of, the world, apparently anyway, is becoming a little less risky, and less risky in general is pretty good for, less perceived risk is generally good for stock prices. So as gold just kind of does nothing, that means people are finding other things to do with their money. buying stocks, and it looks like they're buying U.S. Treasury bonds, and it doesn't look like that's going to end in 2014.
Well, you're clearly not a gold bug there, Andrew, because if you were, that there's nothing else to do with your money but buy gold. That is indeed the only use case for money, and the fact that we ever deviated.
Diversify with silver.
Yes.
Come on now.
The fact that we ever deviated from the gold standard.
I think.
The height of heresy. That there's no longer a gold standard. But we'll get into that on another day. Our metals tinfoil hat show. There's so many other topics to hit on in 2014 we didn't have a chance to get to. We can just touch on a couple. The repeated drumbeat that VIX/vol was too cheap. We heard that legion of times throughout the year. Of course, as we've discussed on this show, and of course, Vol Views and others, that there is indeed still a demonstrable risk premium, even at those moments when VIX cash was hovering around a 12 or 13 earlier in the year, and everyone, when their mother was saying it was too cheap on CNBC and others, you know what? You look at the realized vol, it was about 5 to 6%. So there still was somewhere around a 7 to 8% risk premium still built into the market. So if you look at it pretty much by a realized versus implied perspective, it wasn't too cheap. It was actually probably a little bit expensive. So bear that in mind as you're looking. And also, people see a year like last year and they say, oh, it's easy. All you got to do is buy out of the money calls and you're pretty much done. And it's not that easy, as we've said many times here on this show. Buying out of the money calls is a difficult road to hoe and do it consistently, profitably over time. All the things we've mentioned many times on this show, volatility, skew, theta, all these things are working against you. You could have easily, depending on the product, bought a lot of out of the money calls and done it every consecutive quarter or month and still not done very well, depending on how your product moved. If you moved in a slow, languid fashion to the upside, it's not really going to be that beneficial for your out of the money call position. So don't just think you can look at the market. It went up, therefore I should just load up on some out of the money calls and I'm done. Not always the case. Things are a little bit more nuanced than that. And unfortunately, that's all the time we have for nuance, because it's time for us to keep on rolling into our 2015 special edition of Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody. You know what this segment usually means, but we're tweaking it a little bit. We're going to talk about what to keep an eye on, what to watch, what to maybe think about as we're moving on into the new year. Perhaps, Mr. Alex, we'll start with you. What do you think our listeners should have top of mind? What should they be paying attention to as we roll on into a new trading year?
The sovereign tens, and I know every time I say that, both Mike and Andrew cringe, but our 10-year at 220, rates are going to go up next year. That's not a risky bet. I'll be proven wrong. Looking at VIX spiked today on the overnight news of the Greek elections and what was going on with the ruble. So I would keep kind of one eye on the ruble. The Russians are going to do something stupid. You can just count on them. So I keep an eye on the ruble. But looking at macro events, not a lot of stuff going on here near the end of the year. You know, we're going to have back-to-back years where the market's been up almost 40%. A lot of people look really good. A lot of mutual funds look really good. But watching the geopolitical events, the 10-year rates, and the VIX.
And Mr. Andrew, what do you think our listeners should be keeping an eye out for in the early part here of 2015?
I think that Greek election is the first, last week of January. That could probably put I think that'll probably put a floor on the VIX, at least for this month, and we'll see how the rest, and we've had a couple of years like that where the year started off a little more volatile and ended up, it all kind of went to nothing. So, don't forget about that. If you're a premium seller, maybe you might want to wait and see how things, keep the term really short or wait to see how things develop. Again, you don't know how connected the world is to whatever the Greek issue is and the euro falling apart and Mario Draghi saying he's going to do whatever it takes to save the euro. So all that stuff has worked in the past. It probably will work again, but usually we've had one good scare. The next thing I will say is the growth of social media and how that's going to affect markets and stock prices and, the connectedness of the internet as a growth thing for 2015, like continents, Africa, South America, Asia, where there's still just a lot of people access to cheap phones that have internet access. I think the sky's the limit on the growth for that area. Obviously, it's kind of like the railroads in the 1850s. You're going to have to figure out what are the good survivors are going to be and what aren't. But those are kind of the good threads of the global growth scenario with social media. I don't think we've even scratched the surface of how gigantic that will be once everybody's online all the time. It's inevitable. It's going to happen. And the rate at which things are going, it'll probably happen a lot faster than we think.
So Andrew says, get on ye old information superhighway. I like it.
See.
All right, Mr. Tusaw, take us home. What should our listeners be watching for into early 2015?
Long Apple, long oil, long stocks, short bonds. There's never been a better time in the history of the entire stock market to sell than right now. So with all that in mind, we can say what we want in terms of our projections, our predictions, what we think is going to happen. However, even the best of us are wrong at times. So make sure that you have a plan in case you are wrong next year, as always.
I think to that note, it is probably prudent for all of you. You keep mentioning the record highs we're always hitting here, Uncle Mike, that you indeed have a plan. If you're worried about some downside risk, and who isn't in this market here as we approach record highs again into early 2015, start thinking about all the things we're talking about on this show for ways to mitigate that downside exposure. You can, of course, sell out, or, of course, you can use all the strategies we've outlined many times, not just buy puts, but put spreads, collars, all the things we talked about, risk reversals to mitigate the cost of that protection and make sure you can actually protect your portfolio, not just ride it up and then ride it back down again. And Alex and I talked about it on a few weeks ago on the show, but as the specter of rates returning looms on the horizon, we might actually start talking about Roe again here on the old program, which will be interesting. So if you're not familiar with that Greek, maybe start refreshing yourself on interest rate sensitivity of an options price going into 2015. It won't be a big factor, but it will start to become part of the conversation. Again, we already hit on the volatility of volatility. That's something we want to keep in mind, again, going to 2015. And unfortunately, all of you guys out there who are lamenting the issue of fragmentation and how it's impacting your spread trading, that seems like it's just going to keep getting worse into 2015. We got a dozen exchanges at the end of 2014. By Q1 of next year, we should have the Baker's dozen of 13 with the ISE launching their third exchange. So a lot to really process on that front. And unfortunately, no relief on that front anywhere in sight. But there is relief from this show if you're done with us for 2014, because that's about all the time we have. But before we go, as always, let me check in with each of my cohorts here on the old All-Star panel one last time for 2014, see what they have in store for you. Starting off with you beaming in from the farthest direction, Mr. Andrew, what's coming down the pike in the land of the pit in 2015?
We will have multiple webinars on specific topics. They proved way beyond our estimate on success. People want to see more of them, more complicated topics. I'm not going to say let's make the complicated easy on subjects from volatility products to gamma to diagonal time spreads, all kinds of ways to basically implement and understand the strategies and the conditions when it's right to sort of put something on, where once you understand how the position is going to work, you got a much better chance of making money on it. So you will see a lot of those one-offs from us. And of course, we'll be announcing them on the show, and we'll be posting them on our blog and website. And all of you just come by, and, the market has made it look easy for the last 2 years. So maybe it'll make it easy to make money in the third. Who knows? But I think the topics will certainly help.
Well said, sir. And a happy 2015 to you and the whole Option Pit team. And tossing it over there to scenic, lovely St. Charles. Uncle Mike, what's coming down the pike for 2015 in the land of RCM?
Well, we've just secured some deals with the St. Charles Tourism Bureau. Any option pit listener is welcome to come at any time. We'll give you a free Starbucks or something if you're in St. Charles. So besides that, coming into next year, we're looking to do more things along the lines of financial planning, but with an option trader's perspective. And that if you don't have options formulated into your financial plan, then you might be missing the boat. And so not only were we going to be focusing on options in the coming years, we're going to be focusing on the entire picture. So stay tuned. More education to follow.
Good stuff. I like it. And Mr. Viceroy, take us home. What should we expect coming down the pike from Options Express here in 2015?
lots and lots of free education. I'll showcase a couple events, still one event this year, and if folks want to tune in Tuesday, tomorrow, the 30th, and again, as you mentioned, we're taping on the 29th, I'm doing a 7 p.m. fireside chat from Casa Jacobson for our international customers and domestic customers who want to give up an hour in the evening. Going to talk iron spreads, iron condors, and iron butterflies. Going into January 5th, Nina's going to do a trading platform and site tour. That's Monday, January 5th. Tuesday, January 6th, Jim Wyckoff, who writes the well-known Wyckoff letter, is going to do his monthly take on futures. All the events here at Options Express are free. Come to optionsexpress.com. Click on the Educate tab. You get to hear terrific people like Nina, like Jim Wyckoff, like Dan Gramza from the CME. Every once in a while, they nudge me to do some stuff. I'll have a handful of events in January, but all the events are free. Come to optionsexpress.com and register for an event.
Thank you for that, Mr. Viceroy. And of course, this show wouldn't be possible with our friends over there at Options Express by Charles Schwab. So if you haven't checked them out yet, what are you waiting for? Surf on over there, optionsexpress.com. Kick the tires, light the fires. I think you're going to like what you find. And if you like it, if you like this show, then let them know. Let them know that you appreciate their support. We can't bring this show to you for free without them doing that. So if you've been listening for these 4+ years now or any fraction thereof, and you like what you hear, let them know over there at Options Express. Shoot them an email, find them on Twitter, find them on the website. Say, hey, we like that you guys are part of the option block. We think it's interesting. And they'll, of course, appreciate that you guys are listening, because I know we certainly do here at the Options Insider. You guys are the reason we do all of this stuff, and you're the reason that 2014 was such a big year for us, and we're looking forward to many more fun and exciting things in 2015. So one last time for this year, on behalf of Uncle Mike and the Viceroy and the Rock Lobster, and of course myself, let me thank all of you out there in the listening audience for downloading and streaming and subscribing to the show and for sending in so many great questions. We're looking forward to many more in the new year, and we'll see you all in 2015.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.